Hey, everybody. Hey, everybody. It's Scott with Save Our Shops Louisiana on the LaBizSOS podcast. Coming at you one more week for episode 5. We're going to talk about acquisition and finance structure, how to build deals SBA lenders want to finance, which means that banks want to finance them. Last week, I talked about some potential deals that I have been reviewing. And after the podcast last Wednesday night, I started thinking about, okay, I really need to get serious about working with some lenders and finding what's called preferred SBA lenders. I reached out to my network, set up some meetings, and have been able to talk to a couple. But it really got me thinking this might make a good episode for the podcast because it is something that I'm going through. And if you're ever interested in buying a business or you want to talk about ways to structure a deal, this is a place to do that. So I wanted to create this episode 5. When we think about buying a business, we usually focus on price. And what really determines how a deal is done is how it's structured. Today, we're going to break down that acquisition and finance structure. Those are two different things that are very important to balance each other out. What I mean by that is an SBA lender isn't just lending money to buy a business, they're lending against risk. How we structure that risk and how we present that risk to the bank is going to make all the difference in the world on whether or not they feel comfortable in funding that deal. They're going to ask questions like, will the business generate enough cash to pay for the loan? Is the buyer prepared to run it? And is the seller confident enough to stay involved? That's a key question, and we're going to address that again as we go on. But two deals that have the same purchase price, but one gets approved and the other one doesn't, it can be purely because of structure and the way that the bank looks at that structure. So, for example, a deal for $1.5 million purchase price that has clean financials, the seller is agreeing to doing some financing. So he still has skin in the game to make sure that the business is successful. And there's a clear transition plan. And then that deal is likely to do okay to get bank approval. But the same deal with $1.5 million purchase price with what the bank might consider inflated add backs. Remember, we talked about seller discretionary earnings. So maybe they're adding in things back saying that this is a benefit for the new owner, but the bank doesn't feel that way or can't prove it. And that's usually the case. Or there's no seller involvement. The cash flow is unclear, meaning is it going to be consistent after the seller leaves and the new owner takes over? Most likely that deal is going to stall out or die. And quite honestly, I would probably kill that deal before it ever got to a lender. But again, if you start looking for a deal, you have to think about structure. And quite honestly, the seller should be thinking about structure as well because they have taxes that will need to be paid and other things that are going to be important to how they structure that deal. So the buyer and the seller working together to come up with a structure that a lender likes is a win-win for both the buyer and the seller. So let's talk about some of the core components of a lender-friendly deal or a small business administration-friendly deal in particular. First is the price allocation. So what are you actually buying? When you buy that business, you're not just buying the business, you're buying pieces of it. And there are pieces that are not just the clients or the employees and the service that they offer, but things like F&E, which is furniture, fixtures, and equipment that you will purchase during the acquisition process. Inventory, if they have an inventory, those need to be purchased and be part of the acquisition price. Real estate, if the building is included that the business is hosted at, that will make a difference in how that deal is valued and how it is viewed by a lender. And then there is goodwill. And goodwill is generally the reputation, the relationships, the branding. And there could be a lot of goodwill in a deal. There could be a little bit of goodwill in a deal. And we want to keep that balance in order for, again, the lender to understand what they're lending against and how that is valued in order to understand what they're willing to put up from a structured deal. So a $1.2 million deal might look something like 150K in inventory, 250K in equipment, and then the rest is considered goodwill, $800,000 in goodwill. And the multiple would be included in that as well. Clear allocations in the offer price can help reduce the appraisal and help speed up approvals through a lender. In a previous episode, I talked about valuating a business and understanding its value using a term called seller discretionary earnings. Seller discretionary earnings, or SDE, is how lenders measure cash flow for small businesses and potentially use it to place a value on businesses. It's the most common method used when valuating small businesses and adding a multiple, depending on the business type and the industry that it's in, of using a multiple of seller discretionary earnings is one of the most common ways to do evaluation. Add backs might include things like owner salary, personal vehicle expenses. So if you're using a personal vehicle, but you're writing it off as part of the business, so you're using it for both. One-time legal or repair costs if you own the building. These can be added back in as they're not normal expenses that the new owner necessarily has to take into the business. What lenders don't like are things that are aggressive or undocumented add backs, creative adjustments that inflate the earnings. So if a business shows $200,000 in net income that's going to the owner, but claims an additional $150,000 in add backs, lenders are going to scrutinize every dollar because, again, I hope I would call that out before ever taking the deal to a lender. But clean, conservative add backs build trust, make a deal easier for it to move forward and get that financing. Another thing I mentioned a little bit earlier, and that's seller financing, or that making sure that the seller still has some skin in the game. Seller financing basically means that the seller leaves some money in the deal as a loan to the buyer. This shows confidence in the business. It shows confidence in the longevity of the business, the transition capabilities of the business. It shows confidence in the buyer and in the overall transition that the buyer has probably laid out to the previous owner. A typical small business administration loan structure would include something like 10% buyer cash down, 10% seller financing or a seller note, and then 80% guarantee on the SBA loan, which is the most common type. It's called a 7A loan. It's the most common type of SBA loan. And the seller financing can be placed on what's called standby, meaning the seller doesn't get paid until the SBA loan is current. And this reduces the bank's risk, the lender risk again. The lenders or financiers, they also want to know that there's enough cash in the business, working capital in the business to keep the lights on after the loan payment is made. So the cash needed to operate after the closing on the deal, payroll, inventory, utilities, lenders want to know that the business won't run out of cash in a month after they close the deal and then it can't pay the loan. So if payroll is $60,000 a month and inventory cycles every 30 days, lenders want to see enough cushion to cover that. Sometimes the thought process is a little bit longer than that, 60 days, 90 days. Deals that don't address this early on often struggle, particularly if you're looking at seasonal heavy cyclical businesses. You want to make sure that there's enough cash on hand in order to get through those cycles. So for example, if you're buying a landscaping business and you're buying it in September, you probably only got a month worth of working revenue, depending on how the business operated, but mostly it's the summer, spring, busy times for a landscaping company. Winter months are going to be slow months. So How is that going to be cared for in the structure of the loan? Is there enough working capital to keep the business going during the first cyclical downturn or seasonal downturn? That's going to be very important for a lender to understand, and that's a question that they're going to ask. So, buyer experience and transition plan. This is one of those things that when I talk about having experience in multiple industries, having a network in multiple industries across the state, it's important that the lender understand that even though I may not have years and years of experience in the exact same business before, that it is important that they understand that I have experience in operations. I consider myself an operations professional after 30 years running operations in multiple industries. I have transferable skills that can go from businesses that I have run into a new business that I acquire. I understand what it means to be a leader, to be the CEO, to be the core person at that business. And I have a plan on how to transition that business and work it into my skill set and working it into continuity, developing that continuity. And oftentimes lenders will want to see things like the seller is willing to stay on and that I am willing to work with that seller for 3 to 6 months to transition that business. That the seller will take me around and introduce me to his core customers, for example, that he'll train me, help me transition with the staff so we don't have a heavy turnover during the acquisition. Lenders want continuity, not chaos. That's something that is critical to a lender. And of course, as a buyer, that's going to be critical to me too. Some of the most common deal structures that SBA lenders prefer. Again, I mentioned the 7A loan. Pretty standard structure with a 7A loan, 10% down on a 10-year loan, no balloon payments. It's a predictable monthly payment, and the structure works well for service businesses, wholesale businesses, construction businesses, where you have a fairly consistent revenue stream. You have predictable monthly payments on a loan, a very standard loan, in where you borrow money and you're making that payment over a period of time, most cases in 10 years, back to your lender. The lender is guaranteed by the Small Business Association up to a certain percentage of that loan, which is why they're more willing to do those types of loans. Then there's the business plus real estate. And when real estate is included, lenders actually can get more excited because there's more collateral. There's a longer loan rate. You can do up to 25 years. There's lower monthly payments because the loan is stretched out, and there's actual physical assets involved that can be used as collateral. So, for example, buying a business for $1 million and the building for $800,000 in addition can dramatically improve cash flow compared to leasing a building. So you're building equity at the same time that you are doing cash flow from the business. You're not paying rent, you're building equity. And this is all part of the deal. Earnouts is another structure that can be used when I'm considering a deal. I want to look at the owner and see if earnouts are one of the ways that can benefit both myself and the seller. But you have to be careful when borrowing money against an earnout. Earnouts are part of the purchase price based on the expected future performance of the business. And the SBA can be pretty strict on the rules here that earnouts cannot give the seller control. So the buyer must maintain control of the business, and the payments cannot tie to ownership. They're often structured as consulting fees or bonuses instead. It's not a direct payment like an employee type of structure. But earnouts can be a good way to keep the seller engaged in the business. They can earn a little bit more money, assuming that the business reaches certain goals. So if, for example, the goal is to grow this business 10% for the next 3 years after the seller closes the deal, and the seller has confidence in that, then he may agree to an earnout to make more money and take part of that 10% growth in earnings, right? It could be a good structure, particularly if the seller's interested in sticking around for a while, and it can help with his tax structure as well. So why the right SBA lender changes everything. So as I mentioned, the lender is generally a bank or some other type of institution that works with the SBA and underwrites the loan with the SBA guarantee behind it of up to a certain percentage. I think it's usually around 80% of a loan that can be guaranteed by the SBA. But not all SBA lenders are the same. The right lender is going to help with the pre-screening of the deal before I waste my time. They want to see the numbers. They want to see the tax returns and the add backs to understand, is there a financeable deal here at all? And do the multiples make sense? So make sure, hey, Scott, we think you're overpaying for this business. And as such, we're only going to guarantee 60% or 70%. If you really want it, you're going to have to come up with the rest yourself. It really is the lender telling you that if they're not willing to do it, maybe you should rethink about it too. They'll explain all the SBA rules very clearly. They'll want a clean understanding of what you're going to be responsible for once you agree to a letter of intent or to a purchase price. They'll help you structure the notes correctly. They understand Louisiana industries. I'm specifically looking for lenders that are based here in Louisiana or have a significant business lending practice here in Louisiana. And they should be quick to communicate. So I would expect communication back within 24, 48 hours consistently from someone who's working through a deal with me. We want to close the deal as quickly as possible. Time kills more deals than money and structure. So we want to make sure that we close that deal very quickly. And a good lender will understand that, what a good structure looks like. And that good lender might say something like, hey, if we add a seller note on standby and adjust working capital, this deal becomes financeable. So it doesn't have to be just, we're not going to structure the whole thing. It might be, hey, let's structure it differently and we'll be able to finance this. This guidance up front can save months on the back end. And that's important to the seller because, as I said, time kills more deals than anything else. So getting that money back and closing the deal is important to both myself and the seller. Before we close this out, I want to bring a lender in early. I want to find that lender. I want to send him deals as I'm discussing them early on, as I'm evaluating them. If it checks all the checkbox, with the exception of the funding, I want to send it to my lender and get his feedback on that part of it. Remember, he's that expert, right? I'm an operations expert. I already said that. So bring him in early. Don't overpromise. The deal has to be clean. It has to make sense. And then focus on stability, not creativity. Lenders want to know that the business is stable, that the cash flow is going to be stable, that they're going to get paid. Just like anyone else that's doing business, you want to know that you're going to get paid. Excuse me. So I mentioned some of the gear last week. This is our Save Our Shops mug with the storefront design. This is the musician cap. I think I usually wear the crawfish hat. That's my favorite, but go to soslouisiana.com, get yourself some merch, help support the mission. All right. Let's see. When dealing with brokers, which is, as I mentioned last week, is a critical, they control a lot of the deal flow and the relationships in these smaller deals, in these $1 to $2 million size deals. They want to make sure, and you want to make sure, that they're providing you clean financials, that they have realistic expectations set for the seller. If you're talking to a broker or you're looking through deals that you may be interested in following up on, that's not necessarily realistic. And a lot of that, the broker who's controlling that relationship has to control that seller and make him understand the business is only worth 3 to 4 times in most cases, depending on the industry. Again, there are some variances there, but for the most part, then you want a broker that's engaged and encouraging the seller participation. Get him to meet with me, with the buyer. And that also a broker who understands lender and SBA timelines to keep me in check, but also to set expectations with the seller. So Deal structure isn't about gaming the system. It's about building confidence. When buyers, sellers, brokers, and lenders all are aligned, deals close faster, financing closes faster, business transitions more smoothly. That's how we keep Louisiana businesses locally owned and thriving. So remember, shop local, keep Louisiana businesses in Louisiana hands. That's it for me tonight. I hope you enjoyed tonight's episode. If you have any questions, be sure to leave them in the comments. Make sure that you check out our other videos. Make sure you subscribe. It's free. Follow us on social media on Facebook, Instagram, and LinkedIn, where we post lots of great and informative articles. We call out local businesses. If you have a favorite, if you think an owner might want to come on, there's a chair back there, but I can put it right here. We're going to start having guests on within the next 2 episodes. Been working out some dates and times. Even had someone offer me up their podcast studio down in the New Orleans area. So next time I'm down there, may cut an episode down there. It's very exciting stuff. I hope you're learning something. I hope you're having a good time. Again, let me know how it's going, what you think. Leave it in the chat. Thanks for tuning in.